Welcome back, everyone, and I'm your host, Stephen Norris, and as always, my co-host, Michael Dodd, Megastar Financial, and today we're talking about loans. Now, obviously, in the real estate process, when you are buying a property, you need a loan to go buy a property, unless you are all cash, in which case, still, please contact your professional lender and realtor to see your options, because you may not want to go all cash, and we can talk about that a little bit further. But for today, the basic process of when you're looking to buy your properties is that you have to get qualified to see if you can even buy the property in the first place. Now, be very careful, because I know there's a lot of different calculators out there on the internet. Home mortgage calculators are a dime a dozen. And now I think that personally that's a good first start. But in order to see what your true numbers are, to see what you can buy, you gotta talk to your professional lender. So Michael's here, and this is what he does every single day. He's no slouch, all right? Don't be mistaken, all right? Just because he's nice, he's no slouch. Now, that being said, when you are getting qualified from a professional lender, that is different than getting approved by a lender, all right? We'll talk about the difference about those two, a qualification versus an approval, all right? Now, once you are approved from your lender, you will be given a choice of options to choose from for your loans. You'll have conventional loans, FHA loans, VA loans, USDA loans, and what are the difference between all of those? We're going to discuss that. But for today, we're talking about conventional loans. Michael's going to be going through what is a conventional loan, what is it not, how does it differ slightly through the other types of loans, and then also what are the misconceptions that the public have about these types of loans that they need to be aware of. So that being said, Michael, take it away.
Thanks for the great introduction, Stephen. I appreciate that so much. Well, first and foremost, guys, since we're talking about conventional loans, a conventional loan is a type of mortgage that is not insured or guaranteed by the government. Instead, it's a loan that is backed by private lenders, and its insurance is usually paid by the borrowers. So usually these loans are basically backed by Fannie Mae and Freddie Mac. And if you're not putting 20% down, that's what their insurance that they're talking about there is, the fact that you'll be paying that mortgage insurance on the back end of yourself. So it is also the most common loan that we do, especially in today's environment, because of the fact that the mortgage insurance will drop off on that loan. And I'll talk about that here in a couple more minutes. So as far as conventional loans, they are loans, like I said, that are backed by Fannie and Freddie Mac. And there are several different options. There's this misconception out there with several people that you need 20% down to buy a home on a conventional loan. And that's because you need to avoid MI, mortgage insurance. Well, it's not true. Fannie Mae and Freddie Mac both have loans that actually let you put 3% down, 5% down, and any other denomination thereof. But the 3% loans are better than, it's less down payment than on an FHA loan of 3.5%. However, you do have to make 80% of the median income of that county, of that area where you're buying. So that'll change with county to county. So like Stephen said, it is really important that you literally talk to a lender that actually can make sure that, that your income qualifies in that range. The good news here is on the conventional loans, as I was saying, is that if you are putting down less than 20%, there's mortgage insurance. If you're in that 3% range, they actually give you an affordable mortgage insurance because they want to try to make that payment a little less for you. And so that is one of the great things about that. And the 3% down of the 80% of the median income of that area is that the mortgage insurance will also be a little bit less. So in saying that, that's what's great about the conventional loan. What's also great about the conventional loan is that we know in today's environment that all our properties are going up all the time. I mean, it's crazy. I think our average increase here in Colorado over the last year has been anywhere from basically about 9% to over 20%, depending on where you live. So what that means to you as a buyer is that there is a good chance that your mortgage insurance will drop off. The rule is, according to our mortgage insurance providers, is that you have to have mortgage insurance for a minimum of 2 years before it will drop off, or you have to refinance out of it, a year later. We all know that there's a good chance that interest rates will be going up. So that's what makes the conventional loan look so attractive, is the fact that that mortgage insurance will drop off fairly quickly for you. And that's a great thing in that sense, because on an FHA loan, mortgage insurance is on it for the life of the loan. Mm-hmm. So what we tend to do with that is that if we can get borrowers in the conventional loan, they have a longer term setup of that mortgage insurance dropping off and their payment going down. So that is another reason why you need particularly to talk to a lender to make sure that you're doing those side-by-side comparisons so that you can make a more informed decision about what loan suits you better. Because the FHA loan is also a great loan, but it just depends on the circumstance of you, the buyer. So, Stephen, do you have any questions that I might be able to answer for you on the conventional side?
Yeah, I mean, I think one of the biggest things that people talk about in the public when it comes to conventional loans is, what's got to be my minimum credit score to get that conventional loan, because that seems to be one of the biggest reasons that people go from conventional to an FHA loan, because my credit score isn't that awesome. So what does it actually mean to have a good enough credit score?
Well, that's a really valid and great question, and that's why we do the side-by-side comparisons, right? Because when you have your credit score is below 700 on a conventional side, that MI starts to get a little bit pricey. So that's why we like to do the comparisons and lay them out for the borrowers. So they can ultimately see what's going on, and we can educate them on what's might be a better loan for them. Because ultimately, Stephen, it's not about the interest rate. A lot of people think that, getting a loan is all about the interest rate because that might be a lower monthly payment. But really what it's all about is the monthly payment, right? So sometimes on the conventional side, that interest rate might be a little bit higher than on FHA, but the payment might be lower, quite a bit lower. But that's where that credit score is really going to drive that mortgage insurance on the conventional side. And depending on what that credit score is, we really need to look at that. As far as qualifying and trying to figure out that score, here at Megastar, we want you to have a 640 and above credit score. Right. So on that, saying that, depending on what it is and what kind of debt you're carrying, it's going to be different for every borrower. So make sure that we take a peek at that and go from there, and make sure that you're asking your lender about both loans. So that way you can compare them side by side.
Oh, yeah. And I think that's a really good point, too, because there's a lot of folks out there that really focus on the interest rate. And that's not the end all be all. All right. You could have two lenders side by side. One has 3% interest rate and the other one has 3.5% interest rate, but the payments are the same. How's that even possible, right? Well, because there's a lot of other underlying factors that go into your loan. It's not just about dollar amounts, interest rate, boom, done. There's a lot of different things in there, which is why you have to talk to a professional lender, all right? Michael's other point is it really does come down to a multi-payment. Now, obviously, when I have people ask me that question, well, what should I do? How much should I put down? It's very simple. And just ask yourself the question and just do the math. Obviously, these numbers are not right, but I'm using a round number for easy math, all right? If you have a loan, 3% interest rate, $500,000, this math is not correct, all right? But if it's a $2,500 a month loan and you're putting 10% down, all right? That's just the math that we're going to use for right now, no problem. If you take 5% more than that, that is another $25,000, okay? If your payments only drop, let's just use math, $200 a month. We'll ask yourself the question then, $200 a month times 12 months, that's $2,400 a month that you're going to be saving or having to pay more on top of that loan. So ask yourself that question. That additional 5% is $25,000. If the yearly amount more you would have been paying is $2,400, that's over 10 years that you would have been paying your loan off to get that difference in there. Ask yourself the question, am I going to be in this house for more than 10 years? All right. The second question you ask yourself is, well, what is my financial situation? What's my big picture? All right. What do I want to do with this house? Am I going to be in here for a long time? And I'm planning to potentially have a family. Do I have to get a bigger house? Or what? I already had a family and now the kids are off to college, or you just want to get a smaller property somewhere else? Or ask yourself these questions. And obviously you don't have to have all the answers today. No, you don't have to have all those answers today. You just have to have a goal of what do you want to do? Ask yourself those 2 questions, all right? That's all we're saying. You don't have to have the big picture. That's why you have resources and people around you like Michael to help you guys answer those questions in an actual factual way, all right? Don't be scared by all the noise out there, all right? Anybody has an opinion, all right? Opinions are free. People can say the market's going to go up, down, sideways, blow up tomorrow, but you have to ask yourself that question. What does your gut tell you? What does your gut tell you about your comfort level? That's what it all comes down to.
You're right, Stephen. And those are questions that most lenders will be asking the borrower as well, right? We're going to go ahead and ask those questions and try to dig in there a little bit more so we can make sure that we're laying out those different loans side by side so they can make a more informed decision. And the biggest part about all this is to make sure, my biggest thing is to make sure that I'm educating the borrower and telling them what's in front of them and kind of laying things out and seeing how we can save them money on the right program.
Awesome. Well, awesome, guys. Thanks very much for watching us today, and we'll see you all next time.
Have a great week.